here you go. You should be set.
You want to mention the book while we're at it? Since
Oh, I can model it for you.
a few excerpts from our publication.
I will do the banner one.
Very good.
So this is the financial value and brand imperative that we mentioned yesterday. It is an extension of our original white paper with additional material in it. And one of the most important features is in the back end, it has the profile for the brand evaluators. What is unique about each of them? What is the services that they provide? And all of that material is in here. So please look at it.
Okay, thanks, Frank. So yeah, as I said, this is going to be much of a dialogue, and we're going to talk about how old brands can survive in the current environment. Now, I have no particular definition of old here, other than I know it when I see it or feel it, such as yesterday when Joanna played Ball of Confusion by the Temptations, which came out in 1970 when I was 8 years old, and I know this because I had the 45. And I played the Temptations. I have no idea what was on the B side, but in any event, we're gonna talk through some examples. A few of them I think are actually quite startling. And so these are two of probably several hundred or thousand headlines of this ilk that you will read today. And I think we probably all agree that Procter & Gamble and Kraft Heinz have older established brands within their portfolio. So this is all within the last month. Procter & Gamble, makers of Tide, Charmin, and Pantene, seeing signs of slower spending across its product categories. Kraft Heinz, they're headquartered a mile and a half, I think, that way. They're planning a breakup. There's a lot of discussion about them separating into two separate publicly traded entities. Company stock has underperformed since its mega merger a decade ago, and changing consumer tastes have hampered results. Now, while I don't disagree with anything in that statement, I also think it's a very incomplete statement. And I'm going to get into that shortly. And this notion of changing consumer tastes is going to come up a few more times, I think, as we get into this dialogue. So out of the book Frank mentioned, and I'll not dwell too much on all the numbers, but as I think we heard yesterday from Lawrence and Alfred, it's pretty well known that firm value and stock market capitalizations in the public markets are significantly driven by intangible assets. If you just look at the top example of Procter & Gamble, these are in billions, so current assets of 25 billion. That's cash, receivables, inventory, stuff you can kind of count and sometimes touch. Basically covers the current liability. So essentially that's a wash. And then you have property, plant, and equipment of 22 billion, and yet the market value is Procter & Gamble at nearly $400 billion, in large part because of the cash flows that are generated by the intangible assets, specifically, primarily, I guess, the brands. Here are a few numbers to consider, because these companies have a different ability, or there's a different magnitude in how their sales generate stock market capitalization. So I'm going to get a lot into Kraft Heinz here, so let's start with them. Their annual sales are about $26 billion. And right now they're at a market cap of 36 here. It's actually 33 billion as of yesterday. So think of their revenue producing a stock market capitalization that's just slightly higher than what their annual revenues are. Procter & Gamble's annual revenues are 84 billion. And they generate a market capitalization 4 times that. Could look at it another way. Procter and Gamble's sales are about 3.5 times that of Kraft Heinz. Their market capitalization is 10 times. With Coca-Cola, their annual sales are about double that of Kraft Heinz. And their stock market capitalization is 7 to 8 times bigger. One could argue that Kraft Heinz is barely getting a participation ribbon in the stock market capitalization game. Those are pretty stark contrasts. And I'm going to suggest a few reasons for it. And it's not just changing consumer taste, but as a background, Kraft Heinz got there as a consequence of 2 major transactions. Berkshire Hathaway and 3G Capital out of Brazil bought Heinz, which was a publicly traded company back in 2013. And then 2 years later, they went out and acquired Kraft to form the current Kraft Heinz. At the end of the year, once all this took place, you can see these goodwill and intangible numbers that ended up on the balance sheet as a consequence of giving financial value for those assets. So a little over $120 billion overall on the intangibles. Now, what did they do with them? So let's look at a few numbers here. So you've got the years, and because of those 2 transactions I mentioned, 2016 is really the first full year that Kraft Heinz was in existence. And they pretty much have flatlined at $26 billion. What I will give Kraft Heinz credit for is they actually tell us what they're spending on advertising and marketing. That's actually quite rare in the public markets. I worked for Miller Coors, which was a US business unit of what now is Molson Coors Beverage Company. We guarded that marketing number like it was Fort Knox. We did not want our distributors to know the number. We did not want our competitors to know the number. And that's very common with most publicly held companies. Now, some do disclose it, and you'll see in a bit. Sometimes you have to dig really hard to find it. To the point that sometimes I think they accidentally disclose it when they didn't necessarily intend to. But in any event, going back to the Heinz years, they disclosed something that they called advertising. The definition is essentially media spending. And then they started to disclose advertising and marketing, which when you look at the definition is much more comprehensive. It's probably a pretty reasonable shot at all of their marketing and sales support spending. For instance, marketing would include sponsorship costs. And they've continued to disclose that. Now you can see I've computed here that advertising and marketing percentage in net sales hanging right around in the 4% range. Now this is 7 years old, but at Miller Coors, I can tell you we spent over 10% of net sales on marketing. And with our flagship brands, Miller Coors and Coors Light, it was well above 10% of net sales on those individual brands. So I would suggest we have a problem here, and it's basically built in. It's structural, I believe, within Kraft Heinz. I don't think they're anywhere close to spending enough money on marketing. Yeah.
Yes, certainly that 4% looks very low, but is it also Miller Coors has a more complex channel mix with on-premise and off-premise, and that might account for a slightly higher spend?
It could, but I would probably, I think you're right about that. And there are always those different dynamics. They're all in CPG, but you know, Miller Coors sells through distributors and that's at the retail. So you kind of have multiple audiences,
Yeah.
but I would argue it's not 2 or 3 to 1.
Absolutely.
Would be the point. And even when these numbers are disclosed, you never know exactly what all is in there. Sometimes it may or may not include personnel costs, for instance, salaries of salespeople and all that. But again, the order of magnitude of those things is pretty tiny, and it's not going to move the needle a whole lot. So now remember that goodwill and intangibles. Over the years, $28 billion in write-offs. This is through 2024. In their second quarter, which they just announced a few weeks ago, there was another 9.3 billion of intangible write-offs. This doesn't seem to be working so well. Now I'll get very provocative, and CFOs around the world will shudder at what I'm about to say. So, advertising and marketing just over $1 billion. In 2024, got it here. Kraft Heinz spent $988 million on stock buybacks. They spent $1.9 billion on dividends, which was a 5.8% yield on their stock price. Now, I'm not here to categorically demonize stock buybacks or stock dividends, but one has to wonder if they've got the mix right. And Adrian's not here today, but she said, it's all about the CEO. I would say it's about the CEO and the board. And frankly, I don't think they know what they're doing. I think this needs a serious overhaul. In my world, way back when, it was the early 90s when, at the time I worked for Philip Morris. Does anybody remember Marlboro Friday?
Yes.
When they fundamentally reset the pricing of the tobacco business. Because they realized as market share leader, they had way overpriced the top end, which was allowing budget brands to enter beneath them. And they structurally changed the industry in one day. Their stock price took a whack. I owned it. I remember when it happened. But over the next 2, 3, 5 years, that whole gambit paid off in a big way. They got all that market share back and more. And they thrived because of a very, very, very gutsy decision. I would suggest this might be a good time for Kraft Heinz to make a very, very gutsy decision. Another reason, well, let's look at a few other things. So this is also from our publication, and this specifically is Constellation Brands. And the numbers you see here are specifically their US beer business. Constellation Brands is basically beer, wine, spirits, and cannabis. They're also based about a mile from here. They do disclose in their quarterly and annual SEC filings, marketing spending increase or decrease year on year. Just happens to show up in their discussion and analysis that they provide. So over, I guess it's 8 years, these are their marketing spending increases. Those marketing spending increases are 4.6% of their net sales. And that's just disregarding what the base number is. Going into 2016, I guess it would be. Now, they either slipped or intended it to be so. But in 2023, in one of their Investor Day presentations, which is about 60 pages, on one page, they say essentially they're spending 9% of their annual sales on marketing. and look at the operating income increases they got out of that. And remember, when you increase your marketing spending by $59 million, that's a negative in that 270 number. It's an expense that hits that number, but undoubtedly this was working. And then when I worked at Miller Coors, it drove us crazy. These guys were really, really getting it right. They had excellent, I would argue, with the beer industry, Modelo and Corona have been the stellar performers in terms of marketing content. I think they continue to be, and Modelo is actually, I think just within the past year, they are now the largest sales dollar beer brand in the US. So this was working for them. Another of my former competitors, Boston Beer, they also disclose marketing. It's actually over 20% of their net sales, a little bit more than 4%. Now that we're done with the woe is me part of the presentation, let's look at a company that leveraged an opportunity that was presented to them, and that's Hostess. Also chronicled in the publication. It's not shown on here as sort of before 2016, when Hostess Brands was in bankruptcy. My guess is they were having problems with changing consumer tastes, right? These are definitely old brands, Twinkies, Ho-Hos, and Ding Dongs. But then they were purchased out of bankruptcy by a private group. It's actually the same private group that bought Pabst Blue Ribbon many years prior. Chef Boyardee, I think, was another brand that private group revived. And then in 2016, as you can see, there was a series of transactions. Essentially, they went public with a market cap of around $2 billion. And then they were sold, or they were purchased by Smucker in 2023 for $5.6 billion. They too had intangibles, not a single sign of a write-off. And look at what their sales did over a period of time. They doubled. These were old brands facing changing consumer tastes. And we also read a lot about the health-conscious consumer.
How did they
They
change
seem
that
to love
product?
Twinkies.
How did they change that product mix?
So I really don't know. I haven't dug into that. I know one thing, I think they put out like a Twinkie that had chocolate filling in it. They probably played around with various different wrinkles on the base product. They were probably fairly aggressive in getting into stores, getting shelving right and all that sort of thing. So yeah, I can't speak to all of the reasons. Although what I will say is they also disclose advertising, marketing, and selling expenses. And as you can see, they're kind of in that 9-7% range.
I will say
And
that
it obviously, had some dividends.
Yeah, but I mentioned the other thing that they had for them was a lot of free marketing by being part of the icon. So the problem originally with the Hostess brands was on the operating side of their company, not with the brands themselves per se. So this isn't a story of the brands failing, this is a story of the corporation with labor rules and labor agreements and factories and things of this nature, which was really driving down the value of the company as a whole, while the value of the brands was worth as much as what they ended up with the company as a whole. And part of what happened is that when those brands started to disappear from the store shelves, it became a key point of many movies and if you're in the zombie apocalypse, it was you wanted to get your Twinkies, right? And these Hostess different things. And so they got a lot of play with the disappearance of the brand, ironically. At one point, a box of Twinkies was selling for over $1,000 on eBay as a cultural icon. So they had that big thing, and then so when they did their reintroduction, people were lining outside of stores to actually acquire those brands again. So it really was an amazing thing. It shows just the overall strength of the brand just as they stood.
And I think having looked at, done a quick sort of search on this, is that there's, it has to be not just pushing more Twinkies, it has to be reviving innovation. And they've been focusing very, very hard on innovation.
Talked a lot about
All
that
about
yesterday.
leading people back to Twinkies, but they've been introducing a steady stream of new products like candy bar inspired Casbars and miniature baby bun cakes. And they have also, the health conscious consumers, well, they haven't given up Twinkies being an indulgent treat, right?
Oh, exactly.
But they have started putting things in smaller packets.
I'll have a Big Mac and a Diet Coke.
More things in smaller packets.
Yeah,
So
okay.
that they feel more health conscious. Because there had to be something more than, something innovation happening here.
There's probably a lot of things.
Which I think is a lot of the problem with Kraft Heinz. No innovation, no spending on marketing.
Yeah. I would
You're
agree.
right, Jim. I think it's a lot of things. I've done a lot of projects both for Smuckers and Hostess.
Yeah.
I think the difference is that Smuckers, who acquired the brand, value brands. They know the value of brands, how to position them and market them. And not only the Smuckers brand, which they've done a great job with, but they've done a great job with the brands they acquired from Procter & Gamble. So they have that experience.
But remember the word culture from yesterday.
Yeah,
Right?
and that's what I was gonna say. And they really do care about changing consumer tastes and habits, and they do things. And to Joanna's point, that's what drives the innovation they've been doing is, trying to understand the overarching thing about ultra processed foods and how do they fit in and how do they fit into different segments, menus.
One, to Joanna's point too, perhaps rather than lamenting the rise of the cost or the health conscious consumer, they said, well, let's use that as an opportunity.
Yeah.
Let's downsize it a little bit and
Yep.
that'll sort of, convince people, fool people, whatever you wanna call it.
Yeah, it's a very interesting things that the CEO says. We place a lot of emphasis on product innovation. It's the way that brands become contemporary. It's the way that they stay relevant, and it's the way they create a bridge to a new generation. When I took over Hostess 5 years ago, we'd stopped that process. We'd stopped talking to consumers, we'd stopped innovating. Become more relevant in the business press than in the consumer press. So the trick is balancing innovation with the need to keep making old favorites. One thing he said to your point about the strength of the brand is, one of the great things about our Twinkies, ding dongs, ho-hos, they're interesting, they're relevant. Some of them has that baggage, but it's really joyful. The approachability and unpretentiousness. And an interesting thing they say, he says, if you walk down the street and you have a Hershey's Kiss shirt on, people kind of nod. When you put a Twinkie shirt on, I guarantee you within 1 minute, you'll get a reaction.
Yeah, that listen,
It's a great snacking. Think about that.
So we all listened to that. Now let's go back 10 years to when Kraft and Heinz came together.
Yeah.
Does anybody remember reading a lot about zero-based budgeting?
Yep,
Yeah.
and how that was used, and
synergy was the big.
if you want me to go on a 2-hour tirade, let's just talk a little bit further about how zero-based budgeting absolutely eviscerates a marketing budget.
That was H3G's approach.
That was their,
They had a play, that was their playbook.
it was.
That was all that, whenever they made acquisitions that, as private, investors, that's what they did.
Yeah.
And so they got Kraft Heinz, so they did it to Kraft Heinz.
Yeah.
Now I would argue coming in, Heinz was probably a little late to begin with.
Yeah.
But
Yeah.
Well, it's typical private equity, people.
It was kind of treated that way.
Strip. It was
Yeah.
treated like private equity. Let's strip it.
Yeah. And if you think of that culture versus what you just heard
Yeah.
from what Joanna read, boy, that's night and day.
Yeah.
That's absolute night and day.
Yeah. They stopped talking to consumers. They started focusing on the bottom line only.
Now, I don't know if any folks have ever done it, but I subscribe to the Wall Street Journal digitally. It's actually very easy to write to the author of the article. And it's this one. It was a co-authored piece, and I wrote to both of them. And I presented some of this information. And I said, I don't disagree with anything in your article, however, but have you ever done an analysis of how much money they're spending or not versus other peers? I did get a response from one of the authors. We went back and forth over a couple of times over 48 hours. Short story, it was new news to her. And I don't know why this isn't covered.
Well,
You try to
some of it
find
has
any legitimate media piece that gets into this issue of how much companies are or aren't spending on marketing. I can't find one.
There has been a lot of press about how they stopped marketing and how that was a bad thing. And how they abandoned the marketing mindset. That
And how
has
their
been
brand
covered, yes.
value is gone.
Yes.
There was a
Yeah.
lot about
Yeah.
Kraft specifically that they
Okay.
believe that
Well,
their
that's good.
brand is gone.
Yes.
Mhm.
And they stopped. It's not just marketing, because you have to keep brands alive as a hostess one. You have to keep innovating.
Yeah.
And hostess, snacking is the fastest growing category in food. People aren't having, 3 set meals a day when they sit down anymore. It's snacking on multiple occasions during the day. And hostess fitted himself with that. Kraft Heinz doesn't go that way.
Yeah, and Frank sent me this probably a week or two ago, and I threw it in here as well. And this is just looking at market share in the US carbonated soft drinks area. It's actually over a 25-year period, I guess. You have Coca-Cola, relatively stable, Pepsi in decline, Dr. Pepper in relative ascent. All 3 of those brands, by the way, date to the 1880s. My research shows Dr. Pepper might be the oldest by a shade, but it's probably like arguing what the oldest pub in New York City is. I think 5 different places lay claim to that. But good luck trying to find how much these companies spend on marketing. I went through a number of exercises in ChatGPT, and one of the most common things that comes back is many public companies do not disclose their marketing. So I give it credit. It actually sorted that out. Best as I could determine, though, Dr. Pepper now is part of Keurig Dr. Pepper. So you're not necessarily, if you find a number, you never know exactly which brands it corresponds to, but
a lot of it is about it's the same thing with Dr. Pepper versus Pepsi. Dr. Pepper kept the legacy strength of the brand while innovating and appealing to younger generations. They become cool.
Yeah, and so when we talk about just going back to the question, and we've had this discussion, how do old brand innovation sounds like a big
innovation is
piece. And,
critical.
and to me, Hostess shows that you can innovate pretty much anything.
Well, it's like,
You know,
absolutely.
don't give up.
It's like Steve Jobs had this rule about brands, about the Apple brand, which was that you have to have an innovation you announce every year. And it doesn't every year have to be a major innovation. It can be multiple color iPhones, for example, which it was one year. But you have to have something new every year to keep the brand alive and buzzing. You also have to look at where consumers are going and adapt, like with the snacking trend. Yeah.
It's interesting, Joanna, when you're mentioning, Jim, about innovation. Coca-Cola, I don't know, it's about 5 years ago, they created a culture group, culture marketing group. And that group's job is to kind of keep abreast of various consumer culture, pop culture trends and see and feed that into the marketing and to the agencies to come up with ideas.
Yeah.
So it's interesting that, and Pepsi's not done the same thing, I can tell you. So it's interesting that.
Yeah, when you look at when you look at this, you say, boy,
Yeah.
it's a good thing PepsiCo's got snack foods.
Yeah.
Yeah.
Yeah, to cover up this large.
But what I was gonna say, what my point was that your thing about the changing environment is Coke's kind of, forward-looking and saying, we're gonna look beyond just category dynamics and consumption of soft drinks. We're gonna look at the broader culture and understand that and try to make it work for us.
We did this
Yeah.
study for Jim Stengel's book, Unleashing the Innovators, where we surveyed 200 established companies who do partnerships with startups. And that was one of the ways that they are infusing innovation. It doesn't have to be themselves. They can find a new startup to infuse the innovation. And the biggest learning there was that it was not the specific innovation that they were getting from the startups, but that spirit of culture of that they were trying to imbue into themselves from these collaborations. So that's another way all brands, they don't have to do it themselves. They can find the right startup to help them. And,
Yeah, it seems like the worst thing to do is sort of accept the fact that you're going out of business slowly.
The other thing is that you have to balance. One of the things that I think it was Arnaud said is all of our brands, it's a rule that LVMH has for all of their brands. You have to have 1 foot in the past and 1 foot in the future. Very wise statement. Now, PepsiCo misunderstood. So do you remember the Korean flag?
I
So
don't.
a new CEO came in and decided that the Pepsi logo looked old, and the way to modernize the whole brand, was to update.
That's that. Yeah.
No, that's the redone one.
Okay.
The other one was
It's like a
much worse.
sail? It was a sail, like a.
Yeah,
Like a
yeah.
sail?
It looked exactly like the Korean flag,
Yeah.
which was probably not a good thing.
Yeah.
But what he did was, well, first of all, it was putting lipstick on a pig. Just redoing your brand identity doesn't do anything. Secondly, with the redo of the brand identity, you could see Coca-Cola looks like it hasn't. Dr. Pepper looks like they haven't redone their identities. They look like they're the old ones. They're not actually. They evolve every couple of years. They evolve the logo to keep pace with the times, but they do it incrementally. So they retain the past heritage. Pepsi threw it out, instead put in this Korean flag, complete and total disaster. So the CEO got shut down, a new one came in, and at least put the word Pepsi back. So it's better than it was. And it doesn't look so much like Koreans.
Any other thoughts?
So one of my former students was at Kraft for like 7 or 10 years. He ended up at Miller Coors for a year, but anyway. So we were talking about new products and innovation, and he said, I was there for 7 years and they had a lab and they're doing all their stuff, inventing all these things. And in his 7 years, they came up with 2 things that he remember actually stuck. I can't remember what the other one was, but the big hit during those 7 years was Lunchables. That's it. For all the spending. So when companies come in and say, all right, so you've been spending all this R&D for years, the best thing you come up with is tinier pieces of things that you already sell in a lot more packaging. Now, I have grandkids. They love Lunchables. But and you know, it's a big brand and so forth. But when you compare that to if you think about Febreze, I mean, you can't walk 5 steps anywhere in the world without smelling Febreze. Because originally it was, you know, a fabric refresher, right? Now it's in cars. Now it's in your laundry detergent. Now it's in this, that, the other. There were two brands that came out at the exact same time. One was Febreze, which has grown exponentially. The other was Fit, which no one remembers, right? You'd think people would remember Fit because our vegetables are covered in pesticides. All you have to do is wash them, but we don't need a $4.99 spray. But that's kind of the big difference between you know, effective and ineffective, you know, innovation. It's not just spending the money. You have to have something that
It's truly an innovation.
It's truly an innovation.
Yeah.
But to your point of, you know, the chef R&Ds and other things that are being revived, when companies get to a certain size, the brands are so small, they just get lost in the shuffle, you know. We used to place a lot of students at P&G, and they said, oh, you're gonna go, this is before they spun a bunch of things up. He said, I'm in paper, I love it. I'm like, paper's the dullest thing in the whole world because it's, you know, a lot of capital intensity, on and on. He goes, no, we're small, they leave me alone. Because if I were on Tide, I can't do anything.
Right.
Because if I do anything, the CEO is like, what are you doing? Don't do that. And, you know, hanging up the phone. And so, and just you know, bringing in the small startups, but you have to be willing to not just say, you know what, that's not going to move the top line, go away, right? And I think that's when things get too big, they can't see that, yeah, we could scale this up, you know, and actually have it be meaningful. But if the CFOs are just sitting around saying, what digit is this going to move? And it's not one of the big digits. So they're like, yeah, should we do it? No, let's buy back stock. And then we can all go to lunch because, you know, that's easy, you know.
Now, one thing off the top of my head that Tide has done is, you know, they're in the dry cleaning. If there's a Tide brand, dry cleaning.
Well, also car washes.
And car washes. Now, I don't know how that works, if somebody's licensing that name from or whatever, but, you know, in various MASB publications, you'll see us talk about optionality. And it's the ability of a brand to go into some very adjacent, you know, some distant space sometimes. And we bring up the example of Frozen by Disney. I'm sure when that initial film was released, they never imagined it being on Broadway or there being traveling ice shows, you know, around the country. I also wonder if Kraft Heinz zero-based budgeted their R&D innovation, but any event.
I do have to point out one more thing about
Something
Coke.
else, yeah.
Because we've been hearing about, we should bring back real sugar for Coke. And those of you who are old
Cane
enough,
sugar or whatever.
who are old enough to remember that was the big move with the Coke and Pepsi, the move to high fructose corn syrup. It saved them like 20% on their costs. And they used all that money into marketing and just blew Pepsi away. Once that change happened, Pepsi and Coke were neck and neck, and Coke went this way because they put all the money into marketing and just blew Pepsi out of every restaurant. And so, you know, the problem is that story is older than all of my students.
Oh, yeah, it's way back here somewhere
Oh,
on this.
It's closer to the bathroom.
Yeah, okay.
However, what it shows is, if you want to have, this phase change, you could bring it right to the bottom line. And, what would have happened to the stock? But if you take the person that's been bothering you forever and crush them into the ground, never to come back. They're never gonna come back. And, Pepsi's dead. It's never,
Well, it feels to me like Kraft Heinz is in a similar place to some degree, because they've kind of made a commitment, probably quite explicitly on Wall Street to maintain the dividend.
Yeah, but aren't they going
And
to,
that's
aren't they
a
going to break
painful
up and
move,
sell? I thought they were.
What's that?
I thought they were going to break up and sell. I thought that was in the.
Well, I think the idea was they're
Yeah.
gonna somehow separate into two, I haven't read enough on it.
Certainly they're splitting up.
I know enough to be dangerous, but you could imagine one will be, one might take on a fair amount of the debt, and the other one will pay a dividend, yeah, who
good bank,
knows?
bad bank.
But, but there's always on that bit of financial engineering.
Yeah, they're
The
going
core
to do the same
businesses
thing.
need
They're going to do the same
fixing,
thing.
yeah,
Yes,
David.
Kellogg, they're going to
The
split
elephant,
into two separate companies.
the elephant in the room here is the quality of management. Yes, yes, you need to spend money. But if I'm a private equity firm and I see all this money being spent on R&D or marketing with no return, then it's perfectly rational to say, let's stop doing that. Because it's not getting us anything. So I don't think the private equity people are necessarily irrational. I do think their business model is wrong. I mean, what they ought to be doing is saying, let's replace management.
Yeah.
Now, the problem that we have, now I'll get controversial, is we have an accounting profession that is hired by the people they would evaluate if we were paying attention to the management of assets. And as more and more assets are intangible, there aren't other benchmarks. So you have to ask, how well is the money being spent and who's making those decisions? And what's the return?
So of these companies, who's the chief asset steward? Is it the CMO?
No.
Well, should it be? CMO may have the most control over the most important assets that aren't on the balance sheet.
Well, if you-
That would require-
The role of the CMO.
That would require the CMO understands business.
Correct.
And most CMOs haven't got a clue.
Mhm.
In fact, if you go try to find somebody for a senior marketing position who has ever had a P&L responsibility, you can't find them.
Yeah.
That's a big problem, and that's a marketing problem. It's a marketing, education, development problem. We ought to be putting people through positions where they get exposure to having to make P&L relevant decisions, so that when they get into a senior position, they're actually qualified to do what we want them to do.
So part of this is actually a very serious HR problem.
It really is. It really is.
Yeah.
Dave,
Yeah,
just one other thing
Joe,
about.
I'll get at you,
Oh,
Lawrence.
go ahead.
Yeah, Lawrence. Yeah.
There's I don't know if you've heard of a company in New York City called Authentic Brands Group, I think is the name.
Authentic Brands Group,
Yeah.
sure.
They acquire legacy brands.
Yeah.
Basically the brand name and IP, no property, patent, equipment, just give me the IP. And they basically take those brands back out to market under licensing agreements.
Do they have Sports Illustrated now as a
Maybe.
trademark? But any event,
I know that
yeah.
Brooks Brothers I know they're
Right,
doing
yeah.
a lot of apparel.
Apparel, yeah. Brooks Brothers is one of
Exactly
them,
right.
yeah.
So there is a huge, someone's detected an opportunity on sort of resurrecting brands.
Oh, yeah, there's a whole number of, you're right, Lawrence, there's a whole number of companies out there who operate under the radar.
Well, and the one I mentioned, so Hostess, Pabst, there was a Metropolis Group was what it was
Same
called.
kind of thing.
Dean Metropolis was
Yeah,
the,
and these companies,
the head of it, and his two sons, and they
They're
were
all
really
about-
good at it.
they're all about removing embarrassments from big corporations with lots of brands. So they come and take off their hands the brands that are smaller, older, haven't been invested in, and are kind of messing up the place. And then they treat them properly, invest in them.
By the way, to Tom's earlier point, they don't have to call the CEO. They just do what they want to do.
And they're
We own you and we're gonna do what we want.
they're innovating through positioning. They're not innovating through product development, really. They're letting others develop product and they're just slapping the brand on it for them. So actually they're CMOs with a really keen understanding of a P&L.
Yeah.
And the revenue driver there is licensing.
Yeah, royalties, yeah.
Exactly.
I just,
And it's asset light.
And it's very so you could probably run that from the
Mhm.
beach,
I just wanted to add to.
They don't want a factory.
Yeah. To your point, Dave, about the quality of management, I think you have to also factor in the board. And because when it works, it's a real partnership. And when it doesn't work, the board's kind of ineffective. And the thing that my limited experience with private equity is, by and large, one of the things they look for are either industries where there are no board of directors, like nursing homes and so on. But they also look for ineffective boards. And the business model for private equity is to have no governance. The governance is, as you say.
Or very lean government.
No, it's the balance sheet, because they're looking to straighten it out so they can flip it in some way in a very short period of time. It's a very different, having a governance board with that kind of a business model is a disconnect.
And that's probably why they're stripping out the marketing expenditures. Because they're probably thinking these brands could conceptually be strong enough to sort of withhold a break.
They'll survive.
Strip it out and then put it back
They'll
out.
survive for a couple of years.
Yeah, well, I wonder, I'd like to get everybody's opinion on this, because what Kraft Heinz is now planning to do, which is to split up into two companies. One is the faster growing, condiments and sauces like ketchup, and the other is going to be the old Kraft stuff, the slower grocery store brands. This is exactly what Kellogg's did. So they split into Kellanova, which is the faster growing snacking brands, and Kellogg's, which is the old US cereals business.
Didn't somebody just propose to buy one of them?
Yeah.
Kellogg, correct?
Yeah. So I mean, what they're doing is they're stripping out the good stuff from the legacy stuff they don't know what to do with. Now, is that the right way to do it? Because the legacy stuff isn't good. One company's going to do well, the other one isn't.
Bad back.
Yeah, I don't know.
Just buy one of them.
I'd have to look at the details
Yeah, I mean,
of it.
it's a question, I don't know the answer.
Yeah, okay, yeah.
I mean, another
It's a
thing
great
I'd like
question.
to add to the conversation about how do companies keep, particularly big companies which own portfolios of consumer brands, how do they keep fresh and young? Now, Nick talked about partnering, teaming up with innovators and companies innovating. And another way they do it is by acquiring brands that are innovating. So Mondelez, Pam's not here, but Mondelez, for example, has done a lot of this. They bought Tate cookies, they bought, I can't remember what it's called, sexy single origin chocolate bars. So that's another strategy which they do, which isn't so much, reinvigorating their existing brands. It is adding new sort of, more trend-focused brands, which makes a whole major company look more exciting.
It's not a bad idea as long as you continue marketing them, right? It's one thing Hershey keeps doing that, acquiring smaller brands and expanding their portfolio, but they don't actually put money behind the newer brands. So who knows about some of these things? So that's where they fall short. And I was thinking, Jim, for MASB, there is a real good opportunity to write up guidance directed at the CEO, not the CMO, about what your marketing spend should be. That ratio that you talked about, advertising marketing as a proportion of sales. Maybe for starters, if you don't have data to cover all the verticals, at least start with CPG and say, this is how successful companies invest versus, brands that are struggling. And it's such a good metric. And oftentimes I have had clients, senior C-suite clients coming and asking, what would you recommend we should be investing? I don't think there is enough POVs out there about what they ought to be doing. And I think it's a great point to make that this is what you should be doing if you are seeking to grow.
I mean, that's a great point. To that point is that one of my consulting team, one of the partners, used to. He was the guy who transformed the Ernst & Young brand. If you look at it now, it looks modern and cool. That's all him. It took him 5 years. He transformed it, and he is obsessed, and he's writing a book, which we're publishing sort of snippets from as it comes out. It needs a bit of tidying up, so we're tidying it up and publishing chapter by chapter. And it's a book on CEOs and for CEOs and why they should care about brand and marketing and how they should think about it. So we should, bring Ian into this.
Yeah.
And even I show you those percent of sales numbers, they're kind of all over the place. They're hard to find. You don't know if they're the same.
Yeah.
And, I brought up Boston beer at over 20%. I mean, maybe that should be 15. They might maybe they're spending way too much.
Yeah,
I don't know.
Exactly. And there I would say there's room to optimize. Why are you spending so crazy?
Exactly.
So
Like they spend, you see that big bubble in market cap there?
Yeah.
Well, that was when Truly Hard Seltzer was on a big run.
Yeah.
And that was a bit of a Roman candle, and then you see what happened thereafter.
And I would target a outlet like Forbes or somewhere that is more CEO targeted.
Yeah.
And write a POV. I think it's an opportunity for MASB to stand out as well. And if we need data, I can look into some things that we can provide and maybe start with CPG. If you go too broad, we'll struggle with data, but that's a good thing. Aligned with that, the other part that I was thinking is headlines today is consumers don't trust brands anymore, right? So there is uncertainty, there is turbulence, we are not trusting brands. And instead of trying to build up that trust, what brands are doing is running to influencers. If you think about why all this influencer strategy is so much on the peak, they're trying to compensate.
They're probably filling a void.
Yeah.
Yeah.
Exactly. So I think that's the other opportunity that they are creating for somebody else to own the jobs to be done that they should have been doing.
Yeah.
So the various answers to this question some are quantitative, some are qualitative, the HR thing. Yeah.
I was gonna say too, Jim, that I think for established, quote, older brands, I think how the money is spent is just as important as the amount of money.
Oh, sure.
No, I mean, I think that's the other part of an analysis that needs to be done. I mean, when you look at the big shift of sort of spending going more and more toward activation or digital, they're doing it with, a lot of newer brands or more software kind of type things. And that's why P&G 2 years ago told their agencies, please go back to putting more of our brand investment into regular advertising and not so much in social media. Because, you know, as you say, Crest, Tide, Charmin,
Mhm.
so they're older brands and by and large, they know their consumer base is also older. So it's both the percent
Well, that's,
invested and then
that's
how
the
it's
keeping one
invested.
foot in the past and one in the
Exactly.
future.
Yeah,
Concept.
yeah, and how it's invested.
It's Ferrero who's buying Kellogg,
Oh, okay. Yeah.
which is interesting.
Who is it?
Ferrero. It's
Oh,
interesting because
okay.
that's a chocolate company, but what you will see now, I predict, you will see Nutella Frosted Flakes.
Yep.
Sure, that's coming. They're good at expanding their
For the
brand.
health conscious consumer.
Well, we did a study and we did a lot of work for Cadbury. And one of the things we discovered is that within the healthier foods, like Kind Bars, for example, the best selling ones are by all, hands down by a long way, are the ones with chocolate on. Not the Kind Bars, it's the chocolate ones that sell. Same with Nutella, same concept.
Any final thoughts, or I think we can wrap it up, Frank?
All right, thank you. Well,